WeGetNotes.com does not provide legal, investment or tax advice. The material contained in this and every other communication from WeGetNotes.com is for educational purposes only and is not a representation, guarantee or promise of the results you may experience. Any historical performance data that may be contained in this communication is based on the information presently available to and on the beliefs and assumptions of the management at WeGetNotes.com and does not guarantee future or any other results. Any pro forma or other forward-looking projections that may be contained in this communication are based on current expectations and are based on the information presently available to and on the beliefs and assumptions of the management at WeGetNotes.com. Actual performance may be materially different from that which is expressed or forecasted. Please consult with the independent professionals of your choice should you need or desire professional advice. The material contained in this and every other communication from WeGetNotes.com is not and shall not under any circumstance or for any purpose be considered as an offer to sell any security or security-related product or instrument.
Many traditional real estate investors are unfamiliar with discounted note investing. Although there are significant differences between the two, there are also many similarities. This short video will compare and contrast traditional real estate investing with discounted note investing. For traditional real estate investors, the investment process typically begins with a search for a suitable investment property. Because real estate investors seek to purchase properties at below market prices, they look for things such as pre-foreclosures, foreclosures, that is, real estate owned by banks, or just simply REOs, divorce sales, estate and probate sales, and other motivated sellers. Traditional real estate investors, however, are finding it increasingly difficult to find suitable investment properties. The discounted note investor, however, has no such problem. Assets are available nationwide, and the nationwide ratio of notes to REOs is 20-1. The discounted note investor has much less competition as compared to the traditional real estate investor. Traditional real estate investors will often implement one of three so-called exit strategies after acquiring an investment property. The first of these exit strategies is known as the buy and hold. With the buy and hold strategy, the investor will acquire an investment property, rent the property to a tenant, and then hold the property, collecting rental payments over time. The analogous exit strategy for the discounted note investor is the loan modification. Using this version of the buy and hold strategy, the discounted note investor will purchase a discounted note, modify or reinstate the loan, and then hold the note, collecting loan payments over time. The second strategy is known as the buy and flip. Using the buy and flip strategy, a traditional real estate investor will acquire a property at below market price and then flip the property, selling the property at or near its full market value. The analogous exit strategy for the discounted note investor is the deed in lieu of foreclosure. Using this strategy, the discounted note investor will acquire a note at below market price and then accept a deed in lieu of foreclosure from the homeowner, and then flip the property, selling the property at or near its full market value. The third exit strategy is the fix and flip. Using the fix and flip strategy, a traditional real estate investor will acquire an investment property at below market price, rehab the property, that is, fix it up, and then flip the property, selling it at or near its full market value. The analogous strategy for the discounted note investor is foreclosure. Using the fix and flip strategy, the discounted note investor will acquire a note at below market price, rehab it or fix it, that is, the note, once and for all, through foreclosure, and then flip the property that was secured by the note by selling the property at or near its full market value. Disadvantages to traditional real estate investing often include large cash and credit commitments. Lenders typically require large down payments from investors, and loans are required for the balance of the purchase price of an investment property. Investors are often required to have good credit scores, and lenders often place limits on the number of loans they will make to an individual investor. Other disadvantages to traditional real estate investing include that the investor actually owns the investment property. Rehab costs often spiral out of control, tenants are often troublesome, and there's always management expenses. The advantages of investing in discounted mortgage notes include smaller cash outlays for similarly valued assets. First position notes are typically purchased for 20 cents to 50 cents per $1 of a property's current market value. There are no minimum credit score requirements and no limit to the number of notes that may be purchased by an individual investor. Note investors do not always end up owning the investment properties that are secured by the notes which they purchase. And when they do take title to these properties, they typically do not own them for as long as would a traditional real estate investor. The note investor does not own the property if he modifies the loan. That means no tenants, no toilets, no termites, no property taxes. Nothing but a monthly stream of payments with none of the strings of traditional real estate investing. When a note investor accepts a deed in lieu of foreclosure or has to foreclose, the investor will typically turn those properties fairly quickly, often selling them to traditional real estate investors. This means limited rehab costs and limited holding costs. Profits can then be reinvested. Rinse and repeat. If you would like more information on the exciting opportunities that were discussed in this video, please visit us at wegetnotes.com or call 800-394-3250. Thank you.